Wondering if you should put your car in your limited company? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And of course, this question, I'm surprised we haven't done a video on this earlier, comes up all the time. And that's, should I buy a car in my limited company or should I put through my car into the limited company? Now, I'm going to answer that question. Before I do, if you like these type of videos, make sure to click the subscribe button below so you get notified whenever we release more just like it. Now, there's quite a few different elements going on with the answer to this as to whether you should or not, but actually, I'm going to start with a general rule to say probably the majority of the time over the years you get asked this question, the answer generally is no. Don't do it. There are alternatives, and I'll touch on the alternative at the end. But for now, know that generally it's been a bad idea if you're dealing with a car. Now, this video does not touch on vans, so we're talking about limited companies in the small business world for business, you know, the general stuff we talk about on here. And as always, there's all these caveats and everything else, but in general terms, we're going to say to you, look, it's a bad idea, and I'm going to explain to you why. Now, you would get, so let's say you've got a car and you provide it to you as the director. So you think, great, you will generally get a tax deduction for that because you're providing it by reason of employment. You know, it's there, it's fine. Your company tax bill will come down as a result. You could put all your fuel through, you could put all your, your running costs, brilliant. You'd even get a small percentage each year of the car, or potentially all of the car, as we'll cover in a minute. The downside of it is that what happens is that the company then they look through to you as the director, as the person whoever has this car, but I'm just going to presume you, let's just say it's a normal, easy, one person limited company example, you're going to end up with a big personal tax bill. On top of that, the company is also going to be asked to contribute national insurance on the provision of this benefit. They call it a benefit in kind, basically, and that's where it falls down. It's not really, can the company do it? Because yeah, the company can do it. Is it a good idea, bearing in mind the other tax consequences of you doing this? So what would happen is, you'd get this big tax bill yourself personally. Now, the reason it's a big tax bill is what happens is they say, what was the price of the car when it was first off the forecourt? Great, we're going to tax you at a percentage based on the emissions. So it's based on emissions, how green is your car effectively? I'm sure there's not quite that terminology, but that's the kind of feel you get from it. What are the emissions? Now, if the higher they are, and then so obviously diesel is worse, you get a percentage and you apply it to that base cost of the car when it came out of the forecourt. Now that's regardless of what age it is now, so it's pretty bad if it's an older car, both on the emissions and the fact that it's not worth that amount of money. And then you get taxed on that personally. You get what they call a P11D at the end of the year, generally, that says that's how much taxable benefit you've had, and that's pretty horrendous. And then the company pay on that value as well. And if you fuel the car, wow, it just gets a lot worse. There's a rate for fuel that gets added to it, so it can be really, really expensive. Now, where this changes in recent years, and it can be a little bit more exciting, is that benefit in kind percentage is either zero or very tiny, depending on the tax year you do this in for electric cars. And I say electric, let's just say you'd have to check the emissions to make sure, but at 0% emissions, they're really, really quite good. And as we'll explain in a sec, there's also some quite nice tax reliefs. So if you're thinking about electric, it's worth looking at. But you've got to bear in mind that each year, and this has happened historically over the entire time I've been in this tax game, is that the revenue will creep that rate back up, and eventually you're going to want to get rid of it or do something else with it. But currently, they're quite attractive. So we've seen a lot of people, I can't remember, we might have even done a video on it, buy a Tesla now and offset it against your tax bill, these kind of jokey type things, which are actually genuinely a potential option. So the reason that is going back to the tax treatment of the car in the company. So generally what happens, let's just say you've got an old car and you go and buy a car for the company, relatively old one. It's going to pay a lot of personal tax, but the company is still going to get some tax relief. And the way that works is, depending on its CO2 emissions, it can either get 18% of the value of that car each year knocked off, or probably more likely if it's old, 6%, that's it. And you do the maths on how long it takes to get your 6% every year, it's not particularly impressive. But if you buy in those zero emission ones, you get something called a first year allowance, and that's 100% in year one. So you get to write the whole of that value of that car off against your profits. So me joking about that Tesla, that cost of that Tesla, presuming it fitted the criteria, you'd get to write that all off against your profit and potentially wipe out a large portion of your tax bill, if not all of it. So it is pretty attractive. And if you want to have a look in more detail at those rates in the emissions, I'm going to link it down below in the comments so you can have a bit of a rummage around to see what potentially can be done. And there's actually a company car tax calculator on the revenues site that can help you get a feel for that as well. I suppose what I should say is if the car wasn't available all year, so it was only available for part of the year and everything else, you do get a bit of a restricted benefit. So you don't get charged for the whole year just for having it for a few months, but either way, you're still going to get the charge. Now, when I talked about this percentage percentage per year or this first year. I don't want to get too heavy into it because it's very boring really, but you do need to speak to your accountant or take some time to learn the tax rules if you haven't got an accountant to understand whether how you're buying the car is going to qualify, because these days there's quite a few products on the market where you're doing some leasing, some rent, you might just be renting it, you might not be buying it in full, hire purchase and all this, and it very much depends on the documents as to what you'd qualify for, so make sure that that is also taken into account. Now I do want to touch on VAT as well, because I think a lot of people say, oh that's cool, but I can get the VAT back, right? And actually I think there's a relatively misleading statement on the revenues site about this that says that, you know, if your car's used completely for business, then you're going to be able to reclaim the VAT on the purchase, but in reality that's not really going to happen. Nearly always the VAT on that purchase is going to be blocked because of the fact that it might be available for private use. Now, so just think the VAT treatment's not that great. The fuel, the VAT on the fuel is often restricted as well, depending on what you're doing. Again, that's probably into another video, but it's not as good as it seems. So do bear that in mind, VAT is not all good news. And then we spoke then about personal use and all the rest of it. So the alternate to this, people often say, and I'm sure if you go sit in a pub with anybody that's been in business for many years, they'll tell you, well, I've got a pool car, and a pool car is not taxable. So if you imagine a pool car is designed so that if you had you know, a relatively sized business with a compound and you had a little run around out the back that somebody used to run around between clients and all the rest of it, it means that the individual isn't going to be taxed on using that. Makes sense, right? There's no benefit to them. But what generally happens in the small business world, of course, is that director is going to be taking that car home on their drive. So yeah, they might use it all day for business, but it's still available to them privately. And I've seen it in various different cases over the years in terms of the case law that's available. The fact that it's there, you know, even if you imagine if there was an emergency and your car was parked behind in front of your partner's, you're going to use your car. It's available for personal use, and as a result, quite often those pool car arguments will fail. I'm not going to go too deep into that, but I know we have got another video planned on pool cars. So they are a dangerous thing to be saying, I've got a pool car, and let's just say for the majority of directors where that car is going to be on someone's drive, it's unlikely you're going to be able to claim that either. So as you can see, we're kind of whittling away all the options here. What tends to happen then, so what does happen? Well, most of the time, unless it's electric, you're probably going to say, look, it's probably not worth it. What people then do is they keep a mileage log and they claim back mileage from the company to help offset some of that car. And that's business miles. So again, we could go on forever about what business mileage is, but let's say you're going to a temporary workplace, so you're going out to see your clients, or you know, you're going up to visit a supplier somewhere up north. I mean, we're down south, it's easy to say, but up north, you're going to be able to claim those miles back from your company at 45p a mile for the first 10,000 at the time of recording, and 25p thereafter. So that can rack up quite quickly as well, and that's for business use of your personal car. So you wouldn't get any of the other costs, but you would get this mileage allowance. And that tends to be what the norm has been over the years from a more tax efficient point of view, because if you imagine, again, you can do the maths, but sometimes quite often it's better to draw the money by a dividend or salary or wherever else you're going to have it, and pay for the car personally and claim that mileage back. But not always, and electric has certainly mixed that game up. So there you go, some things to think about, but my takeaway for this would be please, please, please do not instantly start putting your car costs through the company. Forgetting the actual paperwork trail that's required to do this properly. If you start putting those through, you're going to end up in a problem with the tax position that's most likely going to cost you more money than it saves you. And if you do hear those people saying, oh yeah, I 100% put my big old diesel Land Rover through my company and it's a pool car and it sits on my drive, they're probably not staying by the rules. So do bear that in mind when you're comparing with your friends. That's it. If you know anybody that needs to know this information, please do share it with them, subscribe, and we'll see you in the next one.